My name is Rishi Garg. I'm a partner at the Mayfield Fund. We're an early stage venture capital firm. Prior to this, I had a 14-year operating career at a bunch of consumer companies like Twitter and Square.
Josh?
Go ahead.
So I'm Josh McFarland, general partner at Greylock. And at the firm, I oversee a couple of different investments on the consumer side, including one managed marketplace called Sonder in the travel space. I actually got my career started building marketplaces, including being an early product manager at Google, building AdWords, which is kind of like you think of it as a massive managed marketplace. And then from there, I started a company called Telepart, which is in the marketing technology space, built that to about 170 million in revenue, sold it to Twitter, was vice president at Twitter for a couple of years, and then joined Greylock, which had backed me as an entrepreneur, now on the investor side.
Annie?
Hi, everyone. My name is Annie Kadavy. I'm a general partner at Redpoint. Most recently, I was working at Uber, actually on the operating side, and helped build the Uber freight business from kind of zero product, zero revenue, up to several hundred, both employees and revenue dollars. Before this, I was also an investor at another fund called CRV, and there I invested in some other marketplaces like DoorDash, which many of us are probably using more than we have been historically. Recently, and ClassPass and Patreon.
Very nice. Very nice. Great. So we're going to run through a variety of questions here, some kind of introductory and some a little bit more sophisticated for the wide variety of folks we have in the audience. Let's start with the basics. Get everybody on the same page. How do you define a marketplace?
I'll hop in.
So, go ahead.
So I'm curious what you guys think. I think about a marketplace as, in the simplest form, a business that connects at least two groups of people, typically viewed as kind of supply and demand. Sometimes you can have a three or possibly even a multi-side in the marketplace. And as Josh mentioned, there are other businesses that are like ads businesses, as an example, that you could consider a marketplace too.
Yeah, I think that's right. And I'd say most marketplaces are two-sided, and we'll probably talk about those a bunch just because that's where you can talk about supply and demand, as Andy mentioned, in a really explicit way. And that's usually where entrepreneurs tend to focus their time on building those kind of two-sided marketplaces. And the role, I would say, of the marketplace is to, you should, for both sides or multi-sides, depending on the nature of the business, the purpose of the marketplace should exist to do something that couldn't be done before for either side. So there's a sort of this high, what's interesting about them and also very hard about them is that there's this really high bar to make the marketplace sing for its supper in terms of adding value to both sides of the marketplace, which is why so few end up getting to scale.
Mm-hmm. Yeah, and I agree. I think for the sake of this discussion, we should focus on two-sided marketplaces generally. But just as a quick intellectual exercise, can anyone give an example of a three-sided marketplace?
I'm going to think. Andy already mentioned DoorDash, right? So that's an obvious one between the consumer, the restaurant, and the delivery driver. And you've got to make it work for all three parties, both in terms of convenience, liquidity, the price that each is willing to pay or accept. I think that's, the multi-sided marketplaces are ones where I think technology can really play an incredible role. And that's where I think, to Rishi's point, you get to these places where things that start being done that could never have been done before.
Mm-hmm. Mm-hmm. Yeah, and certainly some common two-sided marketplaces include companies like Lyft and Uber, connecting drivers with riders, Airbnb or Couchsurfing, connecting hosts with guests, and so on. So let's move a little bit into the metrics that are associated with marketplaces and marketplace investments and the KPIs. People typically talk about gross revenue and net revenue. And maybe we can briefly define those terms and which, as investors, do you care more about? And when you're looking at a marketplace investment, do you think more about gross revenue growth or net revenue growth or some combination?
I mean, they're both important. Gross revenue is an indication that there's, gross volume of transactions going through the system. In most marketplaces, although not all of them, the business model is a transaction fee on whatever the gross revenue is. So if I sell $20 of food, I take 10% cut or whatever the number is. 25% cut. The net revenue is what pays the bills for the company, for the startup, which is why we care about net revenue. But that can vary really widely. Sometimes the take rate, that percentage is very small, sometimes it's much larger. And then the question is sort of what is driving whatever that percentage is and how sustainable is that? Gross revenue is great, but it can be misleading because if your take rate's really low, you can have a very low margin business. And so you have to think about these things together. Net revenue is sort of the real revenue of the company that you're trying to invest in. And so we care about what the income statement usually looks like and unit economics look like from the net revenue line in particular. All the gross revenue is a good example of both market size, customer impact. I think it's a little bit complicated.
Yeah. One thing I might add that, Josh and Rishi and I have all invested in early stage marketplaces where you might evaluate these metrics slightly differently than what you would at a later stage company as it's growing. And at the early stage, the one kind of addendum net revenue is usually you're going to make some assumptions about how net revenue is going to ideally expand, but potentially contract as the marketplace grows over the course of time. And so another metric that I spend a lot of time on, and I'm sure these guys too, is net revenue retention. And that's like a cohorted view of the people that are paying you money. Maybe it's a take rate, as Rishi mentioned, or maybe it's a subscription in some way, shape, or form. Are they continuing to pay it over the course of time? I think this is, and in an early stage marketplace, actually arguably a more important metric than what your kind of total net revenue is.
Mm-hmm. And maybe this is too simplistic a question, but if you were looking at one business that had 100 million in gross revenue and 1 million in net revenue versus 5 million in gross revenue and 1 million in net revenue, is there a do you have a need in terms of the profile that you would prefer?
Well, I need to know what the total market size is for both.
There's probably a need. I mean, you said, is there a knee-jerk reaction? And assuming if you hold market size constant to Andy's point, then usually making 1 million on 5 million, I would say, is more interesting, provided that there's a pathway to expand and take a meaningful portion of that market share. Because it may suggest, or may not suggest, but it may suggest that you're doing something of real value for the supplier and the buyer, so you're able to command a 20% take versus a 1% take in the other example.
Yeah. The challenge might also be, though, is if those two businesses were in the same market, because then you'd look at the 1 on 100 and believe that 1 on 5 is actually maybe just going to trend that direction. And so you might not have as strong a level of conviction in that margin profile.
Mm-hmm.
Yeah, that's right. Yeah, the worst case is you start out with a 1 on 5 business and then you end up becoming a 1 on 100 business.
That's a bad
thing. The interesting thing about marketplaces, especially today, given all the tools that we have at our employ, is that it's really hard to build a winner-take-all marketplace today. And so most marketplaces only get to true unit economic profitability if they're number one in the space, and they have to be number one by a wide margin. Right. So I think there are a number of examples. In food deliveries is a good one, where you just had too many well-funded competitors that are kind of slogging it out more or less neck and neck, sometimes, all three of them with equal parts of the market share in a given market. And it's only in markets where they've been able to break out as number one that they've shown unit economic profitability. So part of what we do when we look at an investment is certainly would rather see a 20% gross margin, the $1 million net versus 5 gross in the early days. But we also need to believe that there's a pathway to sustain something close to that. I mean, it doesn't have to stay at 20%, but you definitely don't want it to get sort of whittled down to 1%.
Mm-hmm. Yeah, that makes sense. Yeah, sustainable defensibility is always an intriguing topic, especially when it comes to marketplaces and the nature of the defensibility is something we talk a lot about at my. Introduce myself in the introduction. I apologize for that. My name is Daniel Hoffer. I'm with Autotech Ventures. We do ground transportation investments. So that's the perspective that I'm coming from. But it's a pleasure to interview all of you who are generalist investors, not just focused on ground transportation. One of the topics that just came up with regard to how you view those investments is the topic of market size. And so is there a minimum market size necessary to get you excited to invest? And I realize that sometimes market sizes can change. They can expand into adjacent markets and so on. So, but from a founder's perspective, when they're assembling their pitch deck and looking at their own industry, what size does a market need to be in order to be of interest to investors?
I'll tell you from our perspective, this is really just like a rough rule of thumb, but we have a $1 billion fund, and historically we've been able to turn that into, call it somewhere between $5 and $7 billion for our limited partners who invest with us. And most of those gains come from very, very big bets that we take in companies that get big upside. So historically, Airbnb, LinkedIn, Facebook, Workday, Palo Alto Networks on the B2B side. And so the rule of thumb that we try to approach entrepreneurs with is a simple question, which is what do you have to believe for this to be huge? And huge for us anchors around roughly, call it $100 million in net revenue in the case of marketplaces. We want to kind of be able to pencil that, and it doesn't have to be super obvious today. Like, it doesn't have to be numbers that you can clearly plug into a spreadsheet, but you need a general sense that can roughly get there, even if that includes a couple more turns on the strategy. But yeah, I'd say being able to pencil to $100 million within, call it, like a 5 to 7 year time frame would be a good anchoring point.
So to be clear, we're not talking about market size. We're talking 100 million in net revenue.
Yes, right. Which is sort of the byproduct of a large enough market.
Yeah, and I might just kind of think about that a little bit more. One of the biggest head fakes in marketplaces can be market size, right? Uber kind of being one of the famous examples. Bill Gurley's talked about OpenTable a lot, because if a marketplace is really singing for its supper and doing something spectacular for the consumer and for the supplier, you have to be excellent for both sides. If you are doing that operationally, then usually, not always, but often you can expand the market pretty dramatically. Food delivery as a market, sort of, even though the percentage of food sort of expanded really dramatically for the last 10 years. When we looked at when I was at Square early on, we got into the taxi business, believe it or not. I looked at the market, and I think it was like $12 billion of total revenue in the country in 2011. So, and it wasn't that much better around the world. And so really great marketplaces will enable something that wasn't possible before. And so then the question is, looking at the existing market is often kind of a little bit of a head fake. You have to think at least what we try to think to ourselves in the businesses that we've invested in that have been successful marketplaces like Lyft and Poshmark and stuff like that, is like, hey, can you imagine that everyone might be using this? Like, could this be a service that kind of the everyday person is like, oh yeah, that's like one of my options. Oh yeah, Airbnb versus a hotel. Oh yeah, DoorDash. Oh yeah, Instacart. So that's like more of an interesting rule of thumb, is like, is the work provided something that's really valuable? Because these marketplaces are so hard to build, and then to create the really big outcomes, you need to get not just to 100 million, but could this be a company that ultimately has $1 billion, 10 billion in gross or net revenue, even, because there's so much potential for that, which is a hard thing to see in the early stages, but it's something really interesting. But we try to run that thought experiment as well. And hopefully an entrepreneur is also a compelling entrepreneur in the seed stage who's pitching for an A, hopefully can help the investor dream with them about why that could become an everyday experience. And that's kind of the job that's what entrepreneurs to help us do, so we can dream alongside them as they build a company.
I might add one quick thing to what Richie said, and then I'll answer your question directly in terms of kind of market size minimum threshold. The first is, his point's a good one. The taxi market's the best example I can think of, right? You would have looked at that and thought, or the black car market, right? And you would have scratched your head and thought, like, how big of a business can you build there? The counter is that sometimes markets can look a lot bigger than they actually are too. So with Uber Freight as an example, right? Something, and Dan, you probably know this market pretty well too, right? It's something like $700 billion of freight is moved by long haul trucks in the US every year. You look at that number and you're like, holy shit, you can build a really big business there. But in reality, only about a third of it is addressable. In this case, the market's so big that's still, $250 million market or $1 billion market. So it's, plenty large, but sometimes you have to cut it the other way too. And then to answer the question, if I think about it kind of top down, I get to a very similar answer to Josh, where you're looking for about 100 million in net revenue. To me, that implies a market size of about 40 billion. if I'm assuming a market penetration of kind of no more than 2%, because I'd like to be able to hang my hat on a marketplace that doesn't have to own the whole market, because that is so hard to do.
Mm-hmm. Mm-hmm. Cool. Yeah, that's great perspective. I think I agree. I think I was not actually working as a VC back in the days of Uber's Series A, although I actually was an EIR there at Benchmark around that time. But I do think it's an interesting case study of how looking at the taxi market is very deceiving, and certainly some great investors passed on the deal because it's hard to visualize that. Facebook is another great example. Why would you sell ads to college kids? They don't have any money, et cetera. From a VC lens, it's easy to understand how one might not recognize the opportunity, and that's part of the job of VC to try to think creatively and see possibilities that sometimes even the founders don't see.
Yeah, and I want to add one more thing to what Andy said, which I think is so right on. Like, look at the food market today. It's trillions of dollars, right? So a lot of emerging companies are looking at food as an interesting market because the market's so big, and it is. But then the question is, for these very competitive markets, is the emerging marketplace, the new marketplace, doing so much work in such a unique way for the consumer that your demand ultimately will pull you in these hyper-competitive markets. You can get to that 100 million in net revenue, right? And that's where a lot of companies. That's what's really hard to do. That's what's really hard to do, to find these areas where you're doing something really inspired that can actually break through in a market and capture any share.
I think many founders are seeking some sort of assurance that they're on the right track in order to get funded, and looking for an algorithmic, formulaic kind of approach to metrics, which I realize may not be applicable in many cases, but at the same time, in an interest of trying to address that kind of question and thinking, is there a typical range for gross margins or month over month growth that you are expecting or wanting to see in a Series A marketplace investment? Or to put it another way, what are the ranges that you do see, and what are you comfortable with?
I think it's rare that we would invest if there's, and this is a very rough range, but usually we see, for compelling business that shows that there's some customer pull, at least 10% month over month growth. In the very early stages, you generally have a lot of small numbers. So if you're not able to generate that, then usually there's a question of whether or not there's consumer demand. Not always. And I don't even know what the top end of that is. The question is to double click on what's driving that growth. And is it because that work is being done for the consumer and it is really compelling to both sides? So I guess I'll just give a rough floor, which is sort of like a 10% growth. Although it can get a lot higher.
Yeah, I'll say this is probably the hardest part of putting together these models, if you will, and the expectations around them, is that you, as an investor, you want it all, right? You want to see an entrepreneur who's dived deeply into a small enough niche or specific geo market that they've really started to make the thing sing and hum. And that's where you're starting to see this pull directly from consumers. You're not having to pay for all of your traffic. You are getting repeat usage, as Andy mentioned. And you want the sort of faith that the entrepreneur can expand out of just that niche or out of just that one geo market. And that's tough. So it's almost like you want to see that 10% month over month growth. Take a food delivery service, right, in a specific area of a specific city. And then you want to believe that they can replicate that rapidly across other neighborhoods in the city, and then quickly across other cities, and then quickly across other geos. And so it's rare that we come across a business that we believe both can execute in this microcosm, as well as see an entrepreneur who we think can rapidly expand and with handle the logistics of doing that. It's what my general partner, Reid Hoffman, calls blitz scaling. But when we see it, it's magic. And the analogy that I've come up with is, if you've ever seen tilt shift photography, it's where you can just Google it, and there's some really cool examples. It's actually a physical apparatus that photographers use to both tilt and shift the lens, and it makes, they take a picture of a stadium, for example, and it makes everybody look like these tiny little figurines. And it's this idea that an entrepreneur can both hold the big picture in their mind as well as focus on a really small component of it that makes it seem tractable, right? And actually master that on the path to what is a much bigger vision. And I think the last part, and this kind of dovetails with the last question, is that I think as an investor, you want to believe in some sort of macro tailwind. And so, in the case of food delivery, it's that people aren't going to want to go into restaurants. In the case of something like Etsy, it's that there is an anti-Amazon contingent of the buying population that really wants things that are handmade. Or there's a sneaker marketplace called Goat, right, which does these trades in these high-end sneakers from all the different manufacturers, and you got to believe there's a wave in the aesthetic of streetwear that's going to drive that to be much bigger than it has been historically.
Mm-hmm. Mm-hmm. Cool, makes sense. Are there anything else? Any other factors? We've talked about growth rates, margins, market size. We've not really touched on team, but are there other things that you look for in a Series A marketplace investment that get you excited?
I think you kind of brought up one thing, Dan, in the question beforehand. We've talked about net revenue. We haven't really talked about gross margin. And the one observed phenomenon is, I think we'll all say like higher margin businesses are better, higher margin off net revenue is better. That's great. It shows scalability in software being applied to the service, et cetera. But what I've often seen, at least, is like in the early stages of a marketplace in particular, often gross margin is lower because there's a lot of work being done to kind of make the business work. And if you're being really honest about what your gross margins are, you're spending a lot of operational time, like onboarding the driver and doing the customer service calls and all the stuff you have to do to kind of get this thing to have liquidity and actually gain momentum. And that's also one of the tricky parts about being an investor, is that you have to see that happening. That's very common to be happening in the early stages, and then be convinced of a pathway where, as there's liquidity in a marketplace, the margin might go, the gross margin, the real gross margin might go from something like 40% or 50%, which is not uncommon, even in very good marketplaces. And then over time approach sort of software-like margins at 70 or 80%, because there's some scale effects in the operations of the business that are direct costs. And then the only other point to make on that one that I think is interesting to what Andy said earlier is like on cohorts, we really, you can sustain a lower gross margin business if you're an addictive service that becomes like a utility that just people use a lot and they don't tend to switch very much off of it. So if you're a low margin business has to require users a lot in a competitive market, then that can be really challenging because you don't have the money to be able to do so. But those are some of the dynamics that we think about on the consumer side, at least, about whether or not if a marketplace at any margin level can sort of be sustainable.
Mm-hmm. Yeah, I remember a number of years ago, Bill Gurley blogged about revenue quality, and there's also this concept of gross margin quality in terms of the amount of effort you need to put into to getting the gross margin and the sustainability of that margin. Mm-hmm. Annie, do you have anything else to say?
Oh, I was just going to add one thing I spent a lot of time thinking about. I years ago tried and failed to start my own company that was a localized marketplace, meaning that you have, like an Uber, for example, or DoorDash, you have supply and demand that is net new in every single geo because it's kind of naturally local, right? Mm-hmm. So that is a brutal business. That is hard to like rebuild your supply and demand if you're going geo by geo. And so I think a lot about how how expensive is it to expand. And so if you have a localized marketplace where you are trading goods or services on a local level, that's almost always going to be more expensive and slower to expand than if you are digitally native and kind of call it national or even global from day one. Mm-hmm. And then one way to ask that question, like ClassPass, I think is an interesting example kind of against a bunch of these questions, right? Is sometimes supply is known and you can scale that from an inside sales team really quickly. In the case of ClassPass, like you could literally scrape Yelp and find every single yoga studio and spin class and Pilates studio or whatever in any single geo. And so turning on these new markets was actually very easy, relatively speaking, as opposed to having to go out and find net new supply and of course demand if we're talking about B2C marketplaces.
Mm-hmm. Mm-hmm. Yeah. One of the questions from the audience is how do you gauge a marketplace's ability to drive enough supply to generate sustainable growth? Is that a market size question, or are there specific supply KPIs that you like to look at? And I don't know if that's distinct from demand, because some marketplaces are supply constrained while others are demand constrained. But what are your thoughts on that?
I love to see a marketplace that has a wait list for supply, right? If you're gating your supply, that's a very good sign. I can give you lots of examples of companies that do have that, and they're able to then learn from what happens if I bring on these really big suppliers versus a kind of a bunch of small ones, right? In the case of Etsy, right? What happens if, like, you know, Josh's yarn shop and Rishi's candle shop and, you know, Annie's like homemade coaster shop come on, as opposed to Dan has like kind of been like hacking it at eBay and already does $2 million a year and comes on, and like, what's the implication of bringing on different types of suppliers? Is an interesting test to be able to run. So it shows also the breadth of opportunity, which I think is really an interesting thing to double click on in supply early on. Kind of how broad are the set of users that want to use your platform, and obviously, in my opinion, the broader the better, because that would translate to a bigger market.
And then the one way that I think we could look at that is are the existing suppliers you have like wowed by the fact that they're suppliers? So like if you're an early Airbnb host, you were like, okay, all of a sudden I can pay my mortgage. Wow, out of nowhere, right? They're like literally these life-saving moments on Airbnb. And then the question is, well, gosh, if they really enjoy it, will everyone else enjoy it too, right? Or for some reason they wouldn't. And if the answer is like, yeah, I can see a lot of people getting similar benefit, then you can sort of gauge supply that way. But that it goes back, I think, on both sides of a marketplace, this change or gap in impact to the consumer or the supplier that ultimately helps determine whether or not that can be helpful.
Right. I think we're just about out of time. And any quick comments on the COVID impact on marketplace valuations or Series A valuations in marketplaces?
I mean, I would just offer that there will obviously be some winners whose paths are accelerated from this, and people that continue to struggle. But I do think, you know, marketplaces in many cases remove the friction of the real world. And so I think that if I even look at my parents who are 73 now, like their affinity to potentially order food to their house has gone up tenfold because of the limitations on their ability to move. And that is exactly the type of challenge that something like a three-sided marketplace is efficient at handling. So I think it's actually going to be a really good thing for society in the long run.
Cool. Great. Well, thank you all very much. On behalf of Autotech Ventures, I'm honored to have gotten the chance to speak with you about this. And thank you for participating in the Marketplace Conference. I think we've got about 1 minute, and then we've got several other sessions happening simultaneously, along with breakout rooms and general networking.